Hope you enjoyed your lunch. Welcome back. It's good to have you back in the room as we enter the final stretch of this year's Istanbul Development Dialogue. So what's next? Well, we're going to be listening to how new financing mechanisms can lead to new opportunities. We had a guest who wrapped up the day yesterday, Sean Kidney. He's going to be part of this panel, but moderating, it's his show. It's Mustafa Baltaci. He's the founder and CEO of Fintech Park here in Istanbul. So, Mustafa, I know that you have a diverse group of friends. The floor is yours.
Well, thank you very much, and welcome back after the lunch. And can I have also my great, terrific panelists on the floor, please? Sean, Tej, Anna, Rom. So while you are doing that, so the main theme of the panel is about financing the development growth in new, innovative ways. So this is this is a very hot topic, and we have been discussing it in a multitude of venues here and there. And it is basically at the core of how we define finance as well as financing, right? So finance is not a new thing. It is a very old animal. So even though I find it quite critical, the whole financial services industry in a way, so it is nothing but a conduit in a way. It is the fluid in terms of making the wheels turn in the business world. It is how we make the transactions. It is how we do the business in our daily lives. So, but in a way, we need to reinvent the finance as well as the ways we sort of define it and we deliver it. So I think this is one of the compartments in terms of this panel discussions about new technologies, innovative ways of doing, financial transactions as well as businesses, as well as sort of financing the development and growth towards new instruments, new products and solutions. So, so this is the core of the discussion. So we have 4 great speakers on the panel. As a matter of fact, they are practitioners, each of them. So I think this is what brings the highest value to the content as well as this, to the substance of this panel. So speaking of which, we have Sean Kidney from London. So he's the CEO and co-founder of Climate Bonds Initiative, London. And you already know him from yesterday and through various discussions. And Rom Aviv, he is next to me right here. He's from Tel Aviv, and he's a co-founder and managing partner of ILS. So Tej Dhami. So she is the managing director and founder of the Change Coefficient. She's from London, the UK. And Anna Mai, hope I am right. So she's the fintech leader of PricewaterhouseCoopers from Poland. So let us start with Sean. Sean, I mean, these green bonds, it is another, sort of buzzword in a way. So how do you define it? Why is it so important? So how do you think that it is permeating to the development discussion in the region that we are operating with?
Whether you call them green, purple, or brown bonds, the naming doesn't count. What counts is that capital is flowing to investments that are going to create a future for our children. That's what it's about. That's what counts. When we look at bonds that are around, we can find lots of bonds in the region that could be called green if someone wanted to do the labelling. And that's fine. We put out a report each year of HSBC identifying those bonds and putting them. So, for example, railway bonds from around the region are already listed in that climate-aligned universe of bonds. That's the first point. What the story really is about is how we achieve our policy objectives and how we achieve, or how we deliver a response to the species-defying threat that we currently face. That's one. However, what we find is that investors really like some rule sets around reporting, around product naming. Mm-hmm. Some of you will have bought fair trade coffee in your time. Similar principle, a stamp or a label makes it easier. It's a friction reduction device. So for many investors, they like the fact that there are some reporting and transparency rules that are codified, that they can trust. They like the fact that there's someone looking at whether the kinds of investments actually do what says on the tin, and so on and so on. And that, therefore, you get a thematic market. That's all it is. It's a thematic market that gets enough support from investors that when we get liquidity in different currencies, we get price depression. So in euros, renminbi, and US dollars now, in this green bond market, which is roughly about $600 billion globally and growing, we see secondary market performance being very strong. Green bonds, when you see a correction, hold their value. Other bonds go whoosh, whoosh like that. Now, for a bond investor, that is gold dust, because most bond issuers, or bond investors, I should say, are first and foremost worried about capital retention. Yield is secondary. Larry Fink says he didn't make money giving yield to clients of BlackRock. He made money making sure they didn't lose their money. So that's point one. But you also see a flow-on effect now in liquid currencies. You see investors, or rather, you see issuers reporting what's called a halo effect. So their bonds price cheaper, their other bonds price cheaper as well. That is, the green bond comes out, then suddenly all their other yields, the secondary markets start going down a bit. This is very exciting for a treasury, as you can imagine. And then you get this other halo effect. For corporates, we're now seeing stock price bounces. So green bond comes out, stock price goes up, it stays up. Now, these are beautiful numbers and figures to have if you're in the market. But they've got to be in liquid currencies. It's hard if you're issuing in a domestic currency. With some exceptions, we are seeing some currencies, Indian rupees for example, appetite in the European market for what's called masala bonds. And when NTPC did one of these a couple of years ago, they also got a great price benefit. So because of this labelling, because there's a rule set, because the thematic market meets one of the big concerns growing amongst investors, which is that our future is challenged and we need to take environmental steps to change it, this market is working and it's growing. And last week we saw the Dutch government issue a AAA sovereign green bond, and they went looking for 4.5 billion euros and they got 21 billion euros of orders. That's pretty good. That's a high level of oversubscription. And as you can imagine, they squeezed the price as a result, even on a AAA bond. So the opportunity for the region in this is, how can we first tap those liquid currency markets? Is it possible to handle the foreign exchange risk? If you're in Turkey, no way, Jose. But in other countries, it's a bit different. So Kosovo can, because it's linked to the euro. We have this ready appetite in some markets. The next thing is, can we use this theme to grow appetite for local currency bonds? The answer is yes, we do see that now. There is scope to do that. And can we start developing local markets as well? And there is an opportunity in some markets where we have investors concerned about these issues to start doing that as a flow-on. So, you know, in Kazakhstan, we have a government policy to try and grow green finance. We have various people trying to develop it. We have Baltaci looking at doing a green bond, internationally first, then domestically. That's how you get markets going. But that's the background to it. You know, it's a fantastic story. You know, there's this great myth in investment circles, which kind of got busted in 2008, which is decision-making is rational. It's not entirely rational. People don't look at the numbers of a particular bond. It is rational in a broader sense. People worry about things. They worry about what the future is going to look like and what that might mean to the risk profile of their investments. A lot of them worry about climate change. They worry about sustainability. They worry about the poor. And for those people, about $21 trillion globally is in that particular market, by the way, for those people, this is a fantastic solution. It's not just green bonds, it's now green equities that are coming in. It's all sorts of other things. Now, we can talk a lot about how to grow this, but let me just leave that as the pot of gold for the moment.
So it might be a bit of a technical discussion when it comes to the liquidity. It's quite interesting that you brought that up because issuing a security is one of the steps and listing it another, but making sure that there is trading going on with that, it is a big challenge, right? It is a very common sort of symptom and challenge for the asset-based securities in the financial services industry. So How do you think that it is relevant to the green bonds in terms of having this secondary market, which is quite vivid?
Look, secondary market's a price discovery tool. I mean, the bulk of investors here are buy and hold, which is one of the reasons you've got relatively thin trading. Insurance companies that hold a bond for 20 years. But we need secondary markets so that people can value and they can offload. So if you retire next week, then an insurance company is going to have to wipe out their portfolio to pay your insurance funds. They need to be able to sell. And that's why you need a secondary market. So you used to work at the stock exchange. That's about creating a secondary market from my perspective. We need it in all markets. When you're issuing, it's better to do it. But that doesn't mean that's a dependency. It is entirely possible to do stuff where there isn't a local secondary market and issuance. Now, you can issue in international markets. And one of the things we're going into a phase where markets are going to be transformed. Some of our other speakers will talk about the role of Fintech here. They're going to be transformed. We will have greater access to these now. We already see in the retail side the growth of exchanges and a growing potential for individuals to access investments. There are dentists in Astana too who need to be able to make some investments. Those dentists, or young millennials more likely, are also concerned about climate change. They may have an opportunity to put their money in these sorts of issues. In green finance in China last year, Alipay, year before last, Alipay rolled out a carbon tracker on their Alipay service where you could join, it would track your carbon credits and you would get, they would plant trees if you got to certain sort of points and you could trade credits. Simple, little game. But this is used by 600 million people in China. Within 3 months, in a country where everyone I spoke to said people don't care about climate change or carbon, they only care about air pollution, 200 million people signed up. Now, you're thinking, whoa, is that evidence of a potential customer demand for green financial products? I don't know, I think it's a reasonable hunch. And the green bond plays straight into that. We now have green retail products in Australia, in South Africa, in India. When Yes Bank announced the green deposit scheme, which looks like it smells and looks like a green bond, they raised $1 billion in 3 months in India. This is a country where everyone says, oh, they don't care about the environment. It's not true. And so that becomes the next stage of development for this. Make it available for everyone. So even if you don't have a liquid secondary market in bonds, then have a look at the retail products. Have a look at how you tap domestic capital using this particular theme. Because the truth is, there's a lot more signs we've got to start worrying about our environment and a lot more people are concerned about it. And this is something you can do.
Sure. So speaking of the participation from the market, there's also a bit of a role with the governments, with the regulators, decision makers. So how do you see it?
You don't need governments to start this market, but it's a lot easier if the governments are supportive. We can get a market going with the current availability of assets, but we're reaching in many markets a ceiling of things that can be financed at green finance. The problem at the moment is a lack of product. We can't get enough green bonds in the market, and this will apply to SDG bonds as soon as we can get that theme bedded down and worked out over the next year. We have the investors. We simply need a product. Where's that going to come from? It's not going to come from a small business in Romania. It's going to come from governments and government policies. It's going to come around urban development policies, how to make sure we choose sustainability over the crap we've been doing for 100 years, for example. It's going to involve the agricultural policies and the kind of subsidies and regulations we have. Whenever I'm in Brazil, I say their biggest market's China now. China wants clean food. It buys from New Zealand before it buys from Guangdong. Because of the experiences they've had. Every country in the world needs to be aware of this. Get rid of the pesticides, allow the bees to come back. These kinds of approaches to agriculture and land use, which is sustainable, are actually also important for exports now, and it's green finance. You can get green finance for it. Government has to push these issues. The Department of Agriculture has to change its policy. Transport has to change its policy. More rail, less freeways. Housing needs to change its policy. Every single public housing has to be to a high level of energy efficiency. In Europe, we're forced to do this by European Commission regulation, but we haven't tackled this in Ukraine or Belarus or other countries yet, and so on. Do you see what I mean? And out of all of this, you get a lot of opportunities for green finance, and our investors will get something to invest in. So that's what government has to do. The attraction for government is they don't need to finance all their public policy objectives with taxpayer money. That if you do this, this is effectively green PPA, green public-private partnerships, different forms. You can raise the money from the private sector. And we kind of have to, because what we've got to do in the next 30 years, this is the biggest wave of investment in the history of humanity that we're about to experience. The government balance sheets can't do it. The bank balance sheets can't do it. We have to do everything we can to tap the private capital pools that are there, pension funds, insurance funds, and debtors in Astana. We need to tap all of those.
So what
we
are
need
the
to look at
potential
government
means for
doing the credit enhancement and the minimal regulation required to make the money flow, rather than try to finance it the old way.
Okay, well, thank you very much. And let us jump to Rome. And Rome, why don't you start by introducing yourself very briefly, and we'll go on.
Hello?
Yeah.
Oh, sorry. Yeah, thank you very much for the introduction. I run an asset management firm and an advisory boutique in Tel Aviv focused on alternative investments and in particular on catastrophe bonds. So catastrophe bonds is a sector in financial markets focused on the insurance space, combining methodologies from capital markets, enabling investors gain the exposure to mainly natural disaster risks, and on the other hand, those who are interested to hedge, that is governments, insurers, reinsurers, corporates, to transfer this risk to capital market investors who are compensated by some fixed coupon. So therefore, those instruments are called catastrophe bonds.
So can you please dwell on that? What is really catastrophe fund, and what are the underpinnings behind that, and why there is this relevance to the insurance industry?
Absolutely. So going back 25 years ago to Hurricane Andrew that hit Florida, what happened back then is that the reinsurance capacity disappeared for a while and pricing has become very substantial. So essentially we had a situation where insurance companies and those who are exposed to natural disaster risks were not able just to find the proper reinsurance, that is a way to transfer risk. And what happened is that banks came and said, why don't we involve capital markets? There's much more capacity in the capital markets than in the insurance and the reinsurance space. And they've established a financial instrument called the catastrophe bond, essentially enabling investors interacting directly with those who are interested to hedge their natural disaster risks, transferring those risks to investors and offloading and mitigating those risks from the other side of this equation. These days, the size of the market is about $100 billion US. Most of the capital is coming from real money, so pension funds, insurers, endowments, and essentially those who are interested to get exposure to uncorrelated risks on the one hand, and on the other hand, offer some protection to those who are in need of this protection. So the typical example of a catastrophe bond in the context of this forum, I think, would be catastrophe bonds issued by governments. For example, the government of Mexico, Peru, Chile, Colombia issued a bond offering to them protection against earthquake risks. And very sadly, one bond has very recently triggered, actually, or is very likely to be triggered due to an earthquake that occurred yesterday in Peru. So the way they work is very simple. Essentially, a certain predefined risk or a certain predefined set of risks are defined, like earthquakes, hurricanes, floods, etc. And if those risks materialize during the course of the life of the transaction, the issuer of the bond is getting the proceeds of the issuance. If nothing happens, i.e. if, let's say, during the course of 3 years there are no any hurricanes, no any earthquakes, the investors would get back their invested capital plus predefined coupons or premiums on this. So essentially, catastrophe bonds are utilized by those corporates, insurers, reinsurers, or governments who are very much exposed to natural disaster risks and need additional funding or need additional solutions to mitigate those risks. And the reason why pension funds and other money managers and those who are responsible for providing returns to the ultimate the end investors are interested in this asset class has to do with the uncorrelated nature of these investments. Essentially, financial disasters or financial crises will never trigger a hurricane or an earthquake. Hence, the correlation of those instruments to mainstream markets is very minimal, making those investments very much attractive.
Can you please share some of the numbers in terms of the market towards catastrophe bonds that have been issued so far?
Yeah, absolutely. So at the moment, there are about $100 billion of outstanding issuances of catastrophe bonds. The average return of a catastrophe bond would be roughly 5 to 6%. Many of the sponsors are insurers, but also, as I've mentioned, governments are involved. The asset class is really increasing because A, there is supply, and B, there is demand. On the supply side, many of those who are exposed to natural catastrophe risks are employing this instrument as alternative to traditional reinsurance. There are a lot of advantages to catastrophe bonds comparing to traditional reinsurance. Typically, the investments are funded, i.e. the collateral that is going to be used in case of a catastrophe is being held in a trust account and can be easily withdrawn by the issuer in case that the catastrophe occurs. On the other hand, there's a lot of institutional money interested and exposed to the space. Just to give you an example, a Dutch pension fund, one of the largest Dutch pension funds called PGGM, just allocated or has been allocating around $4 billion only to this asset class. And in the context of impact or social investments, definitely this is a great candidate to tick all the boxes because essentially insurance is about helping, and especially catastrophe insurance is definitely a segment relevant in terms of its help to mitigate financial risks associated with very extreme events. So that's another angle that is commonly used when allocating to those asset classes. So many people are just attracted to this asset class because of the impact investing angle, and then also the risk-reward characteristics, which are one can claim in some cases are secondary to the first objective.
So I'm just trying to picture the whole instrument sort of in a way that so we can better understand it. So Turkey, the country we are at the moment, so it is prone to earthquakes, right, in many places. So let us try to assume that there is this insurance company which is quite interested in that, and as well as a number of investors are there ready to sort of purchase the instrument. How does it work? How does the process work? Very briefly, please.
Yeah, absolutely. So first of all, I'm happy to say that Turkey is actually involved in this space. The Turkish catastrophe insurance pool issued to date around $600 million of catastrophe bonds, protecting the pool from severe earthquake events. The process would be quite straightforward. The interested party would create a special vehicle that would essentially interact directly with the investors. This vehicle would offer a reinsurance contract to the hedger, the interested party in this, and at the same time would issue a bond. The money to support the issuance would come from international investors, including the pension funds I've just mentioned, and this money will be sitting in a trust account. If an earthquake would happen, the money would be basically wired or withdrawn by the issuer and used to pay claims or other purposes.
Okay, well, thank you very much, Tej. So another quite interesting product, social impact bonds. Can you please tell us what that really is?
misleading because they're not bonds in the sense of that we were just talking about. Conceptually, they're very simple. Historically, a commissioner, so someone like a local authority in the UK, would pay for services based on the activity. So if we think about ending homelessness, in the past someone would pay an organization to work with people who are sleeping rough. Today, with a social impact bond, instead of paying for that activity, you pay for the outcome. So you only pay the service provider when those people are taken off the street and when they're sustaining housing. So it's very, very, very conceptually simple. It's not paying for the activity, it's paying for the outcome. And again, I want to reiterate something that Sean said. We get quite hung up on instruments, but it's not about instruments. It's about what they can achieve and why you're using the instrument. So the really important thing is, why would you use a social impact bond? There's 3 reasons that were sort of touted at the beginning. The first is reduced risk, because the risk is now shared by the commissioner, the delivery provider, but also the new third party, the investor, who is paying for the service delivery up front until the outcomes are achieved. So you get a much better spread of risk. The second thing was innovation, because you're now saying to people, we want you to achieve this goal, but we're not going to tell you how to achieve this goal. So you can be much more responsive to the people you're providing the service to. And the third thing that's super important that we sort of haven't explicitly touched on in this panel, but is incredibly important, we have to move towards prevention. Demand is only going to increase over the next 10, 20, 30 years. Climate change and the lack of public goods across the world are creating such significant demand and ruining lives across the world. So we have to move to prevention. That's often hard. You know, in the UK, local government budgets have been cut by 50%. You've got massive immediate demand. So how do you say, you know, hold on, I can't address that, but I'm going to prevent something that's going to happen 3 years down the line? It's a very, very tricky budgetary challenge. And that's what social impact bonds also helped address, because they said, we'll only pay once we prevent those cost savings in the future, and the investor's going to take part of that risk up front. So really what we want to focus on is those 3 things. The other thing that I want to say about social impact bonds is, with the significant challenges we're facing, we need a new economic model. So what we need to move away is this very, very transactional way of working to a much more relational way of working. And social impact bonds, when they've worked really well, have allowed you to do that. So if I take the example of someone who's sleeping rough, if you have a very transactional approach, you say, this is someone who is homeless, the transaction is to give them a house, right? I've ended their homelessness, it's all done. But that is not the point, because most people who are sleeping rough have multiple complex needs. And even if you give them that house today, they cannot sustain that housing. So if you move from a transactional to a relational basis with that person, you start to understand their real needs, and you create a solution that is much, much longer lasting. And impact is much cheaper when it's sustained. Right? That is incredibly important. So sustainability of impact, not just what you achieve today, but what is sustained 2, 3, 5 years down the line, that's when you can amortize the cost of it, and it's super effective and drives much higher social outcomes. The second part is the relationship between the 3 providers. So the commissioner, the delivery provider, and the investor. You bring in new expertise and you're working in a new way that creates better and stronger innovations, and that's incredibly important. And I just want to be clear, we get afraid, and we talk a lot about data and kind of, you know, accountability. And accountability is incredibly important, and I'm not arguing for a reduction in accountability, but tell me, what is more accountable? If someone is working on a solution and they discover there might be a problem and they come and talk to you as a partner today, or if they wait a week, 6 months, a year to come and fulfill their contractual obligations to tell you what's going on, which one is more accountable? And I think that's what we need to move to, that relational kind of constant interaction that is addressing the ever-evolving challenges that we face. And social impact bonds are a way of doing that, as long as we don't get hung up on they must take a particular form.
So at the change coefficient, how do you guys get involved in it?
So we help design social impact bonds. The other thing that we do, and Sean mentioned this earlier, is that whenever we talk about impact investing and, you know, pulling in money from the private sector, we say that, you know, this is all a result of austerity, right? And the budget pressures everyone faces. And so we automatically jump. The solution is money. If we get money, we can fix everything. The problem is, and we've seen this for the last 2 decades, the money has to have somewhere to go, right? That is the real problem. We have plenty of people. If you give me an investment option tomorrow that is going to make me money and make me feel good because I'm helping someone, would anyone in this room say no to that? Would everyone in the room say yes to that? Hands up if you would say yes to that.
It's making me money as well.
Right, yeah, it is. No risk. Money, and feeling good. Wow, okay, I think this is the post-lunch sleepiness. But I'm going to take that as unanimous. Everyone, you guys, you saw that. That was unanimous. So I mean, you would, right? If you could put money in, there's no risk, and you're helping people, you would. The problem is we don't have enough investments at scale to be able to deploy that money. So one of the big things that the change coefficient that we say and we do is we have to focus on the demand side. And that's at two levels. One, it's at that sort of central government, the policy and the corporate level. But the other thing that's super important is that we need to find a way of, what we call the middle up and the middle down. So, there's great stuff at a very high level and great infrastructure stuff, but sometimes we're losing some of the great innovations on the ground that could really address some of these problems. So recently, I was involved in a network that was looking at prevention of the refugee crisis, but through climate, to address some of the climate change challenges. And there were two really local, rural Kenyan social enterprises, very, very small ones. Both of them had working with drought-resistant crops to address the problem of famine during drought. And these are innovations that are remarkable, that could have massive, massive applications. So, while we have to focus at that senior level and that kind of government and corporate level, we mustn't lose those innovations. It's about how we scale and combine the two to create this new collaborative economy. That's the only way we're going to address the problems at scale.
So, speaking of this, how does the financial innovation come into the play? Can you please explain the mechanism, the whole machinery behind that?
Yes, so with the social impact bond, I slightly got off topic, sorry I do that. With the social impact bond, the investment is that where you're now paying for the outcomes rather than the activity, the investor funds the activity until you achieve the outcomes. But again, I don't want to get hung up on this is about it. Bringing in investment capital, because social impact bonds aren't necessarily about that. So we've worked with delivery providers who have funded that working capital. We've also worked with local governments who are the commissioners who said, actually, why are we giving money away to an investor? We've got a good capital budget. We'll be the commissioner and the investor, right? So it's not always about bringing in external capital. Sometimes it is, but in social impact bonds, not necessarily.
So, thank you very much, but I'm sure that there's this, market for the social impact bonds. So what is the size of that?
It's not very big yet. So I talk about focusing on the problem. One of the reasons that we focus on the instrument is, as Sean said, you need markets, right? You need scale and you need solutions that are replicable. And we are very, very early on in the process. And part of the challenge and the reason we're very early on in the process is data. And I think it's been mentioned a few times over the course of the last few days. We really need good data on the cohorts that we're working with, on the cost of delivering services to them, to be able to create the payments and kind of price what the outcomes should be paid at. And we're still not quite, institutionalized in that way. So there isn't kind of a bunch of term sheets that tomorrow we could take out and say, here is a ready term sheet that investors could fund. But that's the goal. That is the goal. And there's some really, in Finland, they're doing great work towards that, and so is the UK.
So, aside from the UK, and what would be the other countries that are active in?
So Finland, through Sintra, have done some excellent work. One of their big ones that they're launching now is a refugee bond. And what's great about Sintra is they've integrated into the mechanism and the machinery of government. So they've got really good data centrally that's helping, drive the success of those bonds.
Okay.
So it's really about those relationships. That's the key thing.
Thank you. So Anna, why don't you start by introducing yourself? We all know, what PricewaterhouseCoopers is, but perhaps you can explain who you are.
Okay. Good afternoon, everybody. My name is Anna Mai, and I'm a fintech leader at PwC, and I won't be talking about PwC, but let me introduce myself. Besides my role at PwC, I'm sitting also at the advisory board of FinClude, which is a non-profit organization dealing with financial inclusion. I'm also a fintech expert at European Commission, European Agency for SMEs, SME Instrument, which is a vehicle financing innovative solutions across Europe. And I'm also an advisor to Ashoka.
Okay, so fintech is another buzzword, right? So there are many underpinnings behind that, and we discuss about, Well, when it comes to social impact, SDGs and many other things, when it comes to the development discussion, I guess we can speak about the financial inclusion, access to financial services, as well as some microfinancing lending activities, including crowdfunding, peer-to-peer lending. It goes like this. There's a long list. What is really going on? Can you please give us a brief, outlook of the fintech industry overall?
Okay, you said that fintech is a buzzword. It's just a word to name some, phenomenon. Of course, it's not that new because I've been in payments for 20 years and innovations in payments and financial services. And even before the fintech description or term was coined, we were dealing with technologies. The technology was slightly different. And of course, if you just have this very narrow perspective, when you call fintech as a technology that is our underlying, changes in the innovations in finance or financial innovation, so then you can deal with the technology. But what I like really is not focus on the new companies that are entering this sector, but just the broader perspective when we call the entire sector is fintech. And we look beyond technologies, because technology, this is a very limited view. And then if you look, of course, I'm dealing with payments, with open banking, with AI, artificial intelligence, with voice assistants and chatbots and all these, solutions that you mentioned. But what I would like to bring to the table, and I can't agree more with, just Tash and Sean speaking about, new financial instruments that I'm not dealing with, is, like the new perspective and what we need to really make use of the technology and innovation. So first of all, we need, scaling technologies, products, services in terms of fintech. So I used to say always, and I really support this, if you're a fintech company, especially if you're a newcomer, and this applies to financial inclusion, this applies to SDGs as well. If you found a niche, a market niche, it should be a global one. So that's the first thing. So you have to scale technologies and you should scale capabilities. Another thing is about, just working together. I'm dealing with fintech corporate partnerships a lot, not only with fintech startups, although we have like a PwC Scale-Up Hub, and this is not only limited to C, it goes beyond, C. So we are just dealing with new innovative solutions across Europe. But I'm dealing a lot with bank and other corporate fintech partnerships. And then, just it's about creating an ecosystem. An ecosystem of not only corporate clients, not newcomers, fintechs, but also policymakers, governments, academias, all the value chain creators and all the value chain players that are involved in this game. So we should create like a collaborative, inclusive ecosystem. And I think I'm already taken, just from the previous panel as well. And so this is the idea standing behind that. And last and not least is the social change, or even not a change, but the transformation, of course. This is a process, this is a journey, digital journey. And of course, just what fintech brings to the table. And if we are talking about the fintech inclusion, but not only, of course, and financial inclusion. So these are the changes and how, social changes, demographic changes, but also how technology changes the daily life of the consumers and how does the technology integrate into the daily lives, how it enters the daily life. And let me give you one example. So this is really just a very high potential dynamic fintech from Hungary called Family Finances. And Sean told us that, just we'll expect like, just more changes in the, investments. So the future will be very dynamic and fast changing environment for investments. Of course, we can talk about any other, area of the banking and financial services in such a way, especially payments. So it will be really just a fast change. So Family Finances, it's a fintech founded by millennials. What they are doing is a youth banking services, millennials banking services. So they really know what they are talking about because they are also the customers. And with use of gamification, they just create a direct link between investments and payments. So, of course, you can just apply that to retail brands, but you can also apply it to other, sustainable investments. So if you buy anything or if you make any transaction, you can also see how the portfolio of shares performs, or the portfolio of bonds, different, funds, and you can just invest even a small portion of your, just budget into the specific bond, share, or any other instrument or a portfolio. So basically they create this, direct link and affiliation, and this is how, just with use of in-app services, you can just create a link, and you can just have this integration between your life on a daily basis. And I think this is really a powerful tool. And just to make a general statement, this is how the technology transforms the lives of the consumers and integrate it. Another powerful example that can be used for, SDGs financing and supporting is also the use not only of the usage, the consumption of the social networks or social platforms globally. So of course there are just billions of users, and social networks is a powerful tool not only for communication but also for payments and other transactions, for financing investments. And especially messengers and messaging platforms are just really growing. And if you look at the statistics, you see that social mobile component is the high potential one and dynamically growing. So it means that people are not only using mobile phone, especially smartphones, but they are also using social media and social platforms with use of the smartphones. And the in-app, services can be also just used for communication and other financial services, and have this direct link to your life and integrate into the services. And one of the examples of such services is chatbots. So if you text, if you message, so then especially for young people, you can use it, just to make transactions, to buy services and to use financial services as well.
Well, thank you very much. It's a very, useful outlook for all of us to better understand what is really going on with it. Because I don't think fintech is confined to payments as well as banking, because it is a cross-cutting, paradigm, touches upon insurance, capital markets, trading. We seem to, see an emergence of many startups, many new solutions that have not been there before. So, but it is not only for a better customer experience, but also for it creates value for the social impact. That's why I stressed out the financial inclusion as well as ease to access to the financial services, because there is this significant population in many countries, not only one single country, but many countries around the world, even in some of the developed countries, that there are people who do not have access to the banking, simple financial services. So how do you see it? How do you value the role of fintech in this respect?
Okay, this is like one level of financial inclusion, just the entry to financial services, opening up the perspective for the, any, consumer and a person in the world to have access to financial services if you have the mobile phone, not necessarily a smartphone, but of course with smartphone it's easier because we are talking about the application then. And, but this is the first step towards the financial world. And now if we're talking about the financial inclusion, we have another challenge. Because let's assume that you already have the access to bank account, to banking services, not even having the proper bank account at the bank or any other financial institutions, but with use of your mobile phone as telcos and other providers that it's doing. But the other challenge, or the next step, is to how to activate, just people to make transactions, and how to activate people to use the bank's account. Because there is the second step or the second level of financial inclusion. And this is just another level, so payments. And then you go beyond that, or you go further, how to use loans, how to use crediting, how to use financing, microfinancing. So just if we talk about financial inclusion, bank account or access to bank services, not necessarily through the bank or any other financial institution, is like the very, very beginning and the very first step. Then you have like, just more transactional approach. So, and if you look at the statistic, this is exactly a challenge because we have, in some, countries, territories like in Africa, in Uganda, in Nigeria, and then also, in Bangladesh, people have access with use of the mobile phones to financial services, but then the penetration and the consumption of the financial services is still, just something to be addressed and to be penetrated. And if you are talking about the fintech, of course, they are not only incumbents as telcos or banks, but there is a plenty of new players coming to the sector as fintech companies, and just there is also potential for these new players, newcomers, to change the industry, especially just because they are creating just a space for new services with use of technology. And also, in terms of financial inclusion, they can bring the value for the end users, for the consumers, to really benefit from microfinancing or micro-lending. And just having said that, because we are so much focused about consumers, we shouldn't neglect or forget the SMEs perspective or startups perspective. Because if we are talking about the financing, we should also touch this financing for SMEs. For two reasons. One, of course, it creates things like, alternative financing and new financing mechanism for, SMEs companies in general. But on the other hand, on the other side, this is just stimulating the entrepreneurship. And if I work with social startups, and I also a mentor, within Ashoka and other, just volunteering organizations, so I really just face this. And I really deal with the companies who really need financing, and they are social startups. Of course, this is this impact investing, and they really bring a lot of value to the sector. But then this is also stimulating entrepreneurship on the social side, or at this, yeah.
Wonderful. So going back to Sean. So Sean, I'm speaking of this technology, innovation, and everything. How do you see the role of technology and innovation into the green bonds market? So do you have any ideas around that? I mean, or is there any relevance in a way?
No.
Okay, good. So,
But
all right, go ahead.
I mean, clearly we are doing a global transformation of our economies in the next 30 years. And a fundamental of that will be how we use and better use technology, particularly in ways for resource management. I mean, there is a major resource footprint for this phone. I accept that. But at the same time, we have a lot of opportunities to be much, much more efficient in how we do things, whether that means doing more of these as video conferences. In the last French election, Mélenchon, one of the candidates, ran his campaign using a very interesting piece of technology. He ran one evening event where he appeared 8 times simultaneously using holograms. Now, that's pretty cool if you're a candidate. Why can't we do more of that and reduce our carbon footprint and get around more? That's a simple thing. Transactions, when I go to Norway, I don't use cash anymore. Who uses cash in Scandinavia? Occasionally you see the odd krona going around. Well, of course, there's a resource benefit, there's a transaction benefit, and so on. Now, in all of these, the trick is to embed our understanding of what it is that is the right thing to do with the economy. So the green part of it simply becomes a tool to be used within that. Fintech, in that sense, absolutely will enable our discovery opportunities, our chances to discover the things that we think are important, and to make sure that what capital we have flows accordingly. All of that will be part of it. But directing a green bond, not particularly. I get a phone call every week from a blockchain startup saying, can I use green bonds for blockchains? Not really at this stage. Work at the back end of banks, so that's part of the broader productivity reform. I'm going to just leave one last thing for my friend before he dives into cat bonds. We do have a productivity problem. In global economies, particularly the developed economies, over the last 30 years, productivity stalled. And we know that wealth creation is linked to our productivity increases. We absolutely need to look to fintech and other forms of new developments, organic, the bio sector, if you like, for productivity gains to be able to fuel our way into a wealthier, dematerialized economy. We can't rely on an economy that keeps building fridges and SUVs and throwing them out anymore. We have to look for more clever and sophisticated ways of creating wealth. And in fact, most of the wealth in the last 10 years in the US, as an example, on the stock exchange, we've seen the S&P go up and up and up. Most of that wealth has been created by IT companies. It hasn't been created by bricks and mortar companies. That's where the wealth and value creation is. And that's something that all countries in this region need to be thinking about in terms of their economic plans. What we're talking about now is value creation in economies that's based on intangible products, if you like, fintech-based, electronic-based, not on old-fashioned building of tractors, which have done in the past, with hopefully some big benefits for better resource management and better footprint on the planet if we do this right.
So, Tej, same question to you. Sure.
As an aside, one of the challenges that we've had, because we've had this concentration of growth in a certain very, very small part of the industry, is we've created monopolies, right? Because when you look at technology, when you look at fintech, there is massive value in networks. And so you see investors, throwing money into companies that lose money to buy that network. And then they sit, like Facebook, like Apple, on this incredible amount of power. And one thing that I want to say is that we mustn't compromise equal growth for growth and productivity gains, because that is not growth that is worth having. So we really need to be careful that when we're talking about fintech, that when we're talking about these other things, we're not creating new monopolies, and we're also not leaving people behind. In the UK now, in many rural villages and even rural towns, you have to pay several pounds to access your own money from a bank account. Right? I mean, that's crazy. And you're talking about people who don't have any fintech platforms. They like having money. It's how they budget. So we really, really need to be careful that we're not talking about things that leave a bunch of people behind, because that is not what the new economy must be based on if we want to succeed.
So,
but also fintech, no, not so much in social impact bonds.
well,
Something on that. So
All
touch
right.
upon what you said, Tash, exactly. So if we are even talking about a technology in terms of fintech, so basically what we should be concerned about and what is the challenge here is the technology understanding, technology consumption, and also technology inclusion. So everything, because, an adaptation. So basically this is the real challenge standing behind fintech or any other tech industry, and every industry is tech-oriented nowadays. And another point that I would like to raise, it is a regulatory framework, because of course fintech and other changes, they couldn't be possible without some regulatory and legislative just updates. And PSD2, for example, for open banking is opening the financial services world for other players, third-party providers. And this is like a positive side. But on the other hand, and so I really believe that regulatory framework or regulation can be a source for innovation, not only just a limitation or any other compliance issue, but also just room for innovation. But on the other hand, we also struggle with so many regulatory gaps, especially in the emerging economies. So there are some, just examples of experimental payment directives and what central banks are doing, for example, in India and also in Nigeria in terms of financial inclusions. But we are still lagging on that, and sometimes, there is a regulatory framework that is really in avant-garde, so just leading some changes, driving some changes. But in many cases, especially when we are talking about the financial inclusion and financing SDGs, this is something that is lagging, and then we are just behind. So we should also keep in mind this regulatory framework.
I think there's this massive discussion
It's
behind.
a challenge.
Sure, definitely. There are many regulatory loopholes, not only in the emerging markets, but globally as well. But speaking of that, I guess there's this monopolization risk, as Tej, brought up. I think it is one of the largest threats at the moment, because we don't control the data. Data is the king, not the money anymore, honestly. It is how it looks, at least. There should be some global approaches and policies towards that.
Yeah, so if you touch, just let me just briefly comment on that. If I'm saying regulatory framework, of course, just I also have this data protection, like financial service protections in mind, not only, just the innovative regulatory or legislative changes that it's occurring right now. So also, data protection, which is very hard to imagine, especially in a global perspective. But
Okay, thank you. Rome?
thank you.
Yeah, so I'd like to just to mention that, you know, from a fintech perspective, what I think is that penetration is closely, in the insurance context, penetration is very closely related to fintech and payments, I think. So from a catastrophe bond, pure catastrophe bond perspective, it's not really required to have a lot of fintech innovation, as from a penetration perspective, the institutions buying the cat bonds can just pick up the phone call and get the paper, you know, in their bank account. However, speaking of penetration levels, I think that getting that enhanced by some appropriate fintech solution is the right way to go. And I'm aware of some, you know, startups, for example, trying to enhance penetration and offering innovative insurance index solutions like weather derivatives to farmers in Africa by enabling them paying through their mobile phone bill, you know. So whatever credit is left might be utilized, for example, to buy insurance. So I think this type of solutions are absolutely, you know, required in order to tackle the very low penetration, insurance penetration levels in some developing countries, and fintech is a key in this context.
I think, Rome, it doesn't have to be only about fintech, because insurance industry is one of the most conventional industries in terms of digitalization, technology, and transformation. So they are a bit lagging behind. So there is this massive potential when it comes to data analytics, you know, artificial intelligence, Internet of Things. So if we can sort of collate the right data in order to measure the risks and come up with the right, you know, solutions and the right premiums, that would be something quite an efficient, you know, way to bring up, you know, values with that, right?
Yeah, absolutely, and I think this is really happening, and maybe this is, I don't want to say the easiest part, but, you know, once you have data, I truly believe you can do a lot of things, you can do everything, but I think from a distribution perspective, this is a challenge. Go and convince someone who has never spent $1 or, you know, a cent in his life buying insurance to buy insurance suddenly. I think in some cases that may happen, unfortunately, only post-events. After the big events happen, then the awareness increases. But before this happens, it might be difficult, and maybe then, you know, some novel methods, enhancing distribution, convincing people, you know, just to buy a product by clicking on the bottom, or if there is some agreement with the mobile providers, that definitely, I think, could in essence help.
Absolutely. So we have 2.5 minutes to go. Any question from the audience? Is it possible to take questions? Sure, right? So while you are thinking that, let us, you know, fill up the time. So can I just, you know, have your insight, or basically, you know, your comments in terms of how you see the opportunities as well as challenges, starting with you, Sean, in terms of the green bonds in the region, left aside Turkey.
Well, I'm not going to the region first.
Okay.
There's a few things that are going to have to happen in the next few years. We're going to have to democratize insurance. So in the same way developing new products for large-scale players, like we're going to have resilience insurance for households. There's a company a cooperative insurer in the Philippines who provides resilience insurance for households in the payout of a typhoon. Just like a cat bond in a way. You get $100, but you get it instantly. Now that is going to become, we need to make sure that everyone has that insurance. It needs to be the equivalent of motor accident insurance in the United Kingdom, because volatility is the new word. This century is going to be a century of extremely volatile weather incidents. It'll happen everywhere. It'll happen with massive snowstorms in New Jersey, as well as cyclones in Mozambique. So we've got to prepare for that. And we need to have if our economies will not be able to survive if we don't have access to some kind of rebuild money really fast. So take the cat bond and make it global and democratized. That's one thing that's going to have to happen. And that applies to every economy in this region. Now, we don't necessarily need to do it with government money, but we will need to do it with government convening, working with the insurance industry. In the same way in developed countries, motor accident insurance is compulsory, is democratized, therefore it's lower cost, but can still be provided by private sector players, and you can have some competition if that's important in the particular market. Secondly, we are going to have to map out what the SDGs actually mean. Like we need to do that in the next 6 months, because at the moment it's as flaky as hell. And we need to understand what are the right investments and whether we're also looking, as we need to, everything through the filter of climate change, adaptation and resilience, as well as mitigation. That's a kind of job. Now, I say that as someone working on the European Union taxonomy. We're publishing our climate change mitigation criteria in 2 weeks' time. It's a stepping stone on a bigger road. In this region, this is what UNDP can help do. Working with governments in the area to map out and really flesh out and discover the investments that are material, not wishy-washy statements of ambition, which is the norm at the moment. Not good enough. And certainly not good enough for investors who want to feel their money is really being used properly. So that's got to happen. And then I'm just going to throw one thing at you for a few countries. Islamic finance. Why has Turkey not seen a green sukuk? Where's the stock exchange gone on this? Your past employer. Why hasn't the government something about it? Why haven't other countries in the region start tackling this?
Well, even the stock market is not very big in here. So
I know, but it should be bigger. You know, we have for those countries that are interested in Islamic finance, we already have the president of Indonesia and Malaysia, where we've seen a dozen green sukuk come out already. Islamic bonds. You know, there is a tenet in the Quran about the protection of the environment, which is absolutely material here. We have an ethical base to Islamic finance, which frankly we in London have to learn from. Put the two together, and we've got a very interesting theme. We saw one out of the UAE a couple of weeks ago. So take that home and think about, as a niche in your countries where you have an Islamic community, about how to grow that. And it shouldn't just be Pakistan, it should be India as well. In other words, there are many communities with an Islamic community within them. Just some ideas for the future.
Well, thank you very much. We are out of time, but please, last word, Tej. So Sean said that there is this massive potential with the green bonds in the near future. So can you say the same thing for the social impact bonds?
Yeah, I think there is massive potential. I think we just have to do it right, because sometimes when we go in over-enthusiastic about things, we get frustrated quite quickly, right? So, these are not straightforward instruments. It's something that will improve the efficiency of what you do. It will deliver better services to your constituents, and it will free up money to invest in prevention of all of the challenges of climate change that we're going to see. So it's essential, but it's not going to be fixed overnight. We need to work on creating the right products. And the other key thing is making sure that once we've got a good social impact bond, we renew it, right? It's not, we have this huge tendency within our sector to get really excited about something. We issue one, it's a 3-year program, that was great, wasn't it? And then 3 years later, we're on to the next thing. Well, if that was great, why aren't we doing it again, right? So we've got to make a better long-term commitment to things. And I think social impact bond could be part of the solution, but, it's not the full solution.
Thank you. So, Anna, 2 things that you see the highest potential in the fintech market.
Or witnessing in the coming years, there will be not only the democratization of insurance, but I guess, access to payments, financing, investing, and even, wealth or asset management. And definitely, just collaborative and inclusive, not only fintech, but financial services ecosystem. Having said that, we should really be careful about not leaving more and more people behind and out of the entire ecosystem.
Thank you. So, Ram, final words?
Yes. The catastrophe bond space is growing. We are actually working with the UNDP and some governments making the case for them to use catastrophe bonds to mitigate natural catastrophe risks. So believe the future is quite bright, and I'm personally quite optimistic.
Well, thank you very much for this, very genuine and diverse discussion. I really appreciate it. I hope you enjoyed it as well. So this is a wrap. Thank you very much for your patience and time.